We will be talking about Web 2 into Web 3 and how to close the liquidity gap. So at this time, if you could please welcome James Bowater. He is the CEO and founder of the Digital Commonwealth, and he will be moderating this next panel for us.
Hello, everybody. My name is James Bowater. I'm the founder and CEO of the Digital Commonwealth in London, and I am the moderator today. I'm just going to get my notes out, which is a good start, and introduce our panel. So we're doing TradFi and Web3, closing the liquidity gap, with a very strict brief of beyond the theoretical delve into the operational reality of institutional treasury at scale. Discover the 2026 playbook for transforming static corporate liquidity into a secure, high-performance and 24/7 capital engine. And I'm going to go down the panel and ask you all to introduce yourselves, but Laurent, we'll start with you.
So good afternoon, and my name is Laurent Majchrzak. I'm heading up digital assets business line at CACEIS. CACEIS is an asset servicer. Just to be clear, CA, the two first letters mean Crédit Agricole. So I'm part of a leading banking group in Europe, and I'm obviously representing traditional finance in this panel.
Alex.
Good afternoon, everyone. My name is Alex. I work at Fireblocks. I lead our go-to-market in EMEA for banking and TradFi. I do have a background in TradFi as well, and I switched to the bright side in 21, so it's been some time at Fireblocks, but it's exciting to see that the gap is closing.
My old mucker, Robby.
Hi, I'm Robby Yung. I'm the CEO of investments for Animoca Brands. For those of you who don't know us, we build products in Web3, and we also make investments as a corporate VC, so that's the part of the business I oversee. And we just recently announced we're sort of entering the TradFi space by launching a joint venture with Standard Chartered Bank for the Hong Kong dollar stablecoin.
1 year from planning to announcement, yes?
Three.
Oh, God. So it goes very fast these days. Simon.
Yeah, hi, I'm Simon Letort. I'm head of strategic initiatives at Digital Asset. I've joined Digital Asset to build the Canton Network 3 years ago.
And finally, Chris.
Yeah, hi everybody. My name is Chris. I'm the founder of Tradias. For those of you who don't know Tradias, we are a BaFin-regulated market maker for digital assets out of Germany, catering to institutional clients. So yeah, we're really trying to bridge that gap and be that bridge between the traditional world and the world of digital assets and crypto.
Right, so I don't want to speak too much because everyone's here to listen to the panel. So I'm going to start with a question to each of our panelists, and then we're going to free flow and see how we get on. All right, so I'm going to start with you, Laurent. Since you're representing such an established behemoth such as Crédit Agricole, why do you think you're on this panel?
Well, that could be a rude question. Actually, it's a good one for two main reasons. First reason, James, is that how many banks did you see on the Paris Blockchain Week today?
Say that again.
How many banks did you see on the exhibition today? Established banks.
Oh, that's mean. That suggests I was looking around.
I was not prepared. There's a question for you.
I've seen the advertising. There's supposed to be lots of them here, but they just like to remain invisible, I seem to remember.
Okay, we're proud to be the only one present on the Paris Blockchain Week for the second year in a row. And I remember last year there was an exhibitor who was distributing some lighters. And on those lighters it was written to burn the banks. And here, I'm here to demonstrate that actually it's exactly the opposite that is necessary in order to have that goal achieved, to have the liquidity gap reduced between Web3 and traditional finance. Actually, our goal is to help traditional finance to transit to Web3, and that's a long process. It's not people talk about an evolution, some say revolution. I would like to share with you that it's not the first one, and it may not be the last one. We had dematerialization a long time ago. there's definitely something very important happening. We think that it's much beyond cryptocurrencies and all the hype and all these things. We see a whole infrastructure moving to a new model and impulsed by a new technology. At CACEIS, just to give you an example, we have adapted our model to help our clients experimenting. We give them the potential to really use the same assets that they trade on a daily basis, and also get an exposure to new types of assets. Not only crypto, also a lot of emerging new tokenized financial instruments. And that's the first hybrid model that we try to put at their disposal to facilitate that transition. Similarly, we did the same with tokenization. We're not a tokenizer. We are like a transfer agent. We are a centralizing agent, major one. So we are helping them distribute their funds. We have enhanced our capacity. We didn't build a standalone model. We have enhanced our distributing capabilities in order to stimulate their wish to experiment. And that's exactly what they do today. They don't heavily invest in tokenization. They currently experiment. And that's the first step towards a transition. And that's exactly what we've been doing.
But how long have you actually, I've jokingly talked with Robby about his important announcement taking 3 years. So you didn't just arrive to protect the banks from burning 2 years ago. How long have you guys been planning this? How long have you actually been delving in?
I could say that I was not born when we started, but it was not exactly right.
I meant in the digital space.
No, it just around 2020, we had a product team having the strong conviction that there could be very important things deriving from the emergence of that technology.
So an overnight 6-year success, right?
But
got it.
We created a true business line in order to put things into real production. Today, it's no longer experimentation. We offer the services mainly in France, Luxembourg. We opening up the door to new entities in Europe. And that is a huge, we have a strong feeling that is going to be a huge success in many other countries.
Formidable, merci. Encore Alex. Alex Chessé.
Yes.
The Fireblocks. Voilà.
Yes.
Given what you are doing with Fireblocks, how do you equip TradFi to deal with this new digital world of ours?
Great question. So in order to respond, I will give first a new figure that we released a couple of days ago. We surveyed 600 plus leaders globally from TradFi, banks, FMIs, asking about readiness to move into the digital asset space. The key number, which I found was actually fascinating, is that 88% of them confirmed that they have budget allocated for 2026 digital asset infrastructure. Only 11% were delaying this until 2027. Now, in those who are ready, only 16% have admitted that they are production ready. And so the gap we're talking about is this 88% of budget allocated and the production readiness. So what we do at Fireblocks is we provide infrastructure that essentially enable banks to launch digital asset capabilities, extracting away all the complexity of managing keys, governance, blockchain nodes infrastructure, and all of the other services associated. So you can think of it as almost like a core banking system for digital assets with native integrations into compliance tools, travel rules tools, governance tools, tokenization tools, so that the banks can basically, in a relatively short time frame, go on-chain and hopefully close that liquidity gap.
Thank you very much. And now, Robby, I've got a special one for you.
Okay.
By the way, Robby and I have known each other for years. I even won an award last year at my Digital Commonwealth Awards, which he didn't turn up to, so I had to go to his office to give it to him. Anyway, so this is my revenge. What do you see as the benefits of blockchain?
Okay.
You don't have 45 minutes for this one.
So I think in the context of the discussion, I think, I'm a little bit of the odd one out here because we come very much from a consumer background. And our focus has always been, even in our institutional business, led through the lens of consumers, because we always think about how do we get the broadest possible adoption, and particularly when it comes to digital assets, we're always thinking about, look, the benefit of blockchain is we can democratize access. And how do we do that the best, right? How do we think about bridging those institutional capital flows to very large, not just retail audiences, but disperse geographical retail audiences, people all over the world, people who've maybe never made financial investments before, because that is really exciting. And I think the best kind of example of that I can give is we hosted a breakfast in Davos a few months ago with Franklin Templeton. And Jenny Johnson from Franklin Templeton is very eloquent on these matters. And so I will paraphrase her. And she said basically something very simple, which is that they sell investment products to customers. And she said, in my traditional business, I need to sell a $500 product to an investor at a minimum. Because if it's below $500, I lose money. That's just the cost of my infrastructure. But she said, now that we're embracing digital assets, I actually have a product line I can sell for $5 and still be able to cover my costs. And so that means that they can open up their portfolio to a completely new audience.
Well, I completely vibe with that. And as you know, I mean, again, sorry, I didn't introduce myself probably at the beginning, but I've been involved with a project called World Mobile for the last 8 years. And we've been quietly addressing the issue of digital access. Half the world remains offline because there was no economic incentive to do it. But listening to what you just said, maybe people will start paying attention.
Absolutely.
And opening up the world as it should be.
100%. And I think this is really exciting because we start to think about what does the world look like when anybody who has $5 to invest can become an investor. Because most people have historically thought that being an investor is something only for people who have a lot of money. But now we're hopefully helping to educate people financially to understand if you have 500 euros lying around, you should do something with it. You can make a return on it. And here are ways that you can do it profitably.
And indeed, that is exactly what the whole point of blockchain really is.
100%.
And I think, I mean, I know that we will reverse back to other points about this, but I mean, clearly, KYC AML is going to have to feature very strongly in order for those people to have that access. Because
if only there were a low-cost, immutable technology on the internet for that.
I know, isn't it funny that happened to be the case that you're answering that question? Right, there we go. We can come back, though. I want to move on, please, if I may, to Simon. I should have got it right in the first place. Sorry,
I mean, it's fine, too.
Simon, collateral needs to be utilized 24/7. How does that work safely?
So we are very much more on the institutional side. So Canton Network is really a network mostly used by large institutions. And so
how many in the network now, by the way?
there are like 500,000 wallets with 800 validators. So we have the top 10 largest banks are live on Canton. The largest asset manager are live on Canton. And to your collateral point, they don't move $5, they move $5 billion. So collateral movements are in the billions of dollars. On a daily basis, there's roughly like $400 billion of collateral movement on Canton. And collateral is govies, US Treasuries, Eurobonds against cash. And how does that relate to blockchain is that we've progressively worked with the largest player to bring these instruments on Canton, on blockchain. So DTCC, who's the registrar for US Treasuries, is now putting US Treasuries and US equities on Canton. JP Morgan is putting JP Morgan institutional cash on Canton. And the type of flow that we see are banks doing treasury against cash, hedge fund like Citadel doing treasury against cash. And what's the value is for these players who are optimizing to the second, they are now able to do that versus optimizing to the day or the T+2 days. And when you do that on $5, it doesn't really matter. When you do that on $5 billion, it's a lot of money that you gain by doing that.
But I mean, obviously, one of the things that I think we all remember or know is that by closing at the weekends, markets get time to sort of catch up and also make some money on the side. Does this close that door? Does that make it even more important to get it right?
Yeah, so what's interesting is, and that's why we have some early adopters who are in both markets.
And sorry, I was going to add the other question about finality to that, because presumably you need secure finality to be able to have that 24/7.
Yeah, so because the assets are natively on-chain,
Right.
when you do trade, you have finality in a few seconds. And you can wonder, like, what's the point of having treasuries on the weekends? It's for players, let's say DRW Cumberland. They have a 15 billion traditional hedge fund and a fairly large crypto desk.
Yeah.
Cumberland, one of the largest market maker. Cumberland needs to fund itself on Sunday, on Saturday, when the crypto markets are open. And now they are able to fund themselves in the regular treasury repo market at 25 basis points over SOFR. Okay. So the 24/7 on TradFi is first interesting for the crypto market makers that have access to TradFi legs, and also on people who are willing to move the money faster than that it is today.
Okay. Cool. I'm going to move to you, Chris, now. What do you see as the obvious infrastructural gaps, if any?
Yeah, obviously, we at Tradias look at this very much from a trading point of view. And I think when we talk to our clients, which are mainly traditional players, so a lot of our clients are neobanks, neobrokers, traditional banks with a large retail base that want to enable their retail base to start trading crypto. We're trying to shield them from a lot of the complexities and the gaps that we're seeing. And those gaps are that we're still seeing a very fragmented market, right? So when you look at where's the liquidity located, unlike traditional markets, there's not one or two centralized exchanges that you can easily access where you find the best liquidity. So even ourselves, we trade with 30 counterparties on the back end to make sure that we can get access to liquidity at all times and pricing, because what we've seen is that especially during times of distress, right, when the market is extremely volatile, marketplaces are down, there's trading interruptions, right, connectivity goes down. So obviously the market infrastructure is just not as robust yet as it is in the traditional markets, which I think is fair because the industry is fairly young, right? And when you look at the traditional markets, that has grown and evolved over 100 years plus. And we need to accept that this is still a relatively young industry, and we need to live with some of these imperfections. The second thing I would mention here in terms of the infrastructure gap that we're seeing is, of course, coming from a heavily regulated background and our customers being even more on the conservative side, is, okay, what about counterparty risk? Right? What's the balance sheet of my counterparties? How do they treat things like AML compliance, trade surveillance, best execution? These are all topics that are extremely, extremely important, and I think we're seeing that with the regulatory framework evolving, that these questions will become even more important over the next few years. But when you look at for provider out there, or you talk to the traditional providers, they struggle mightily in including crypto into their existing framework, right? Because it's a different asset class. It has to be treated differently. Market hours are different. So we've built a lot of those solutions in-house that really facilitate the trading, because in any project that we've done, what we've realized is that the main sticking point usually where a project falls apart is usually on the compliance, risk, and legal side, right? Because they're quite skeptical usually about crypto. And if you can't convince them that you have an institutional grade solution that complies with the regulatory framework and the in-house framework, you're going to struggle. And I don't think we're there yet, right? So there's still a gap, but we've made tremendous progress, I think, as an industry over the last 2 years. I'm going to look at the players on this panel too. I think everybody's trying really, really hard to work on solutions that enable big institutions to access the market in a safe and secure way.
So, I mean, those are, in terms of set questions, that's all I really wanted to ask. But, I mean, you know, the one thing that strikes me is I mean, we keep talking about crypto. I mean, to my mind, digital assets was the sort of the safe word that Wall Street came up with to co-opt our industry, so to speak. Is that changing? I mean, are you seeing that actually the world is getting a little bit more friendly towards the notion? I mean, the disparity between crypto and digital assets, or what do you think, Robby?
I was just going to say, I think there's a third category of that Venn diagram, which are what we in the industry call RWAs.
Well,
where we're essentially tokenizing other financial assets. I mean, leaving aside physical assets, but financial assets for that purpose. So that's one of our biggest initiatives in-house, is working on that, because we see a huge opportunity to take those RWAs and bridge them into the world of DeFi. But there's actually quite a lot of technical challenges when you think about how stuff gets tokenized at the front end, but then how you maintain the permissionless nature and allow it to, have proper KYC and things like that, but then still float into a fully decentralized sort of DeFi world.
But I'm really glad. Sorry, Simon, I'll come to you right next. But I'm really glad you actually did say RWAs, because the one thing that frustrates me about that particular phrase is that there are so many subcategories. I mean, real estate, funds, what I call in my own world, where I'm American Strategic Minerals, right? So we actually dig stuff out of the ground. So we, that's to my mind, jade, gold, antimony, all of those sorts of things. Real estate, we've covered, but is it helpful that it's just a sweeping RWA, or should they actually be split out into their own categories now? And then Simon, will come to you.
I think they're absolutely going to move into their own categories, because there are two different parts of the pieces of that puzzle. One is the methodology of tokenization, because providing that link from the original asset to the digitally native asset is very important, and often that relies on a trusted intermediary to do that, and that needs to be a proper intermediary, needs to be insured, and that is the weak link, if you will, before you enter the fully digital world.
And then we also get into legal and regulatory and all the other stuff.
And then the second part of it is domain expertise. So is this private credit? Is it funds? Is it, rare earth metals, or whatever it is? And there you have to have domain expertise.
Simon, you wanted to say something?
No, I wanted to connect the thread. So RWA, real world asset, like a tokenized fund, a tokenized money market fund, tokenized private credit fund. When you have that, you have a gap, to your point on the gaps, which often comes with the gap of the custodians. And I would say kudos to Laurent on the CACEIS side, is because that when someone wants to buy a tokenized fund, if it's a traditional player, they will usually go see their custodians. And they say, I have this token that Simon told me about, or whatever. Can you handle it? And as of today, that's a gap. CACEIS is one of the first to bridge that gap. And I think that's a big progress, big missing piece that is being completed. We work a lot with Tradeweb right in the room. We have some fairly advanced players, let's say SocGen and Citadel. They both have their kind of wallets on Fireblocks, etc. And they can trade with each other. But then when you have like a pension plan, they'll say, I'm not going to develop all that. I'm going to rely on my custodian. And I think the missing piece that is being completed for RWA are the custodians.
And the reason being that obviously we are an independent trusted party. We are guaranteeing security, compliance, and that's something which is not always obvious to transpose in that new ecosystem. And that's where we try to, in a way, bridge that gap as well, to keep that role of trusted party by giving them the benefit of having wallets at their disposal. But we entrust the private keys.
And also, they're not going to move everything on chain overnight. They're going to have 99% of their position in your regular system, and they don't want have two systems and have two different views of their positions.
Yeah, and one of the benefits of what we did is that we wanted to mitigate the effort of our clients. We have arranged things in such a way that for a client of a CACEIS today who wants to trade for the first time in crypto assets or buy tokenized financial instruments, they will send instruction by using the same communication mode. They'll receive the existing reporting absolutely maintained. They just have extra connection to via the blockchain, via an explorer to get access to their assets. But that's what we tried to incentive them to try, because there was a lot of resistance. And everybody know what I mean by this. Even in our own organization, we were asked to be very prudent with what we did. But that's one good idea, I think, to help them to make the first step.
I think Alex is itching to get in. Come on.
Slightly controversial view here. We do see the need for TradFi issued products on the crypto native side of things as well. We see it more and more, and it's already starting to happen. If you take the money market fund from BlackRock, the Beetle, it is accepted and used as collateral on crypto trading platforms such as Deribit, for instance. So there is definitely demand, even on the crypto native side of things, for TradFi issued products, in order, for instance, to use as way of collateral to trade options and futures, for instance.
I mean, speaking of collateral, I mean, and talking about the breadth of RWA definitions that we've touched on, I mean, are there things that you see as being excluded for the time being? Or do you see a world where everything can be tokenized? Or digitized?
It's a difficult one. Theoretically, you can tokenize everything, but as you were mentioning, like that first link between the real asset and the on-chain version is the weak link. I think there are progresses to be made here. Now, in terms of real-world assets, I think the vast majority are yield-bearing assets. If you think about treasuries or private credit, for instance, and there is a massive demand for that, both in TradFi and in Web3. And there is infrastructure that is being deployed as we speak between TradFi organizations to actually make sure that this gap gets filled as quickly as possible. And I think this is the exciting part for us this year.
Chris, you jump in.
Maybe just to add to this, because we also have a tokenization arm, and we've tokenized all sorts of assets in the past. We've tokenized the users fund, we've tokenized equities, we've actually tokenized an old timer, we've tokenized art. So we've really done a lot on that side. And I think the question of tokenizing and including, let's say, everything, in my opinion, you have to take a step back, and we had to learn that too. And it's like, okay, what kind of value proposition or enhancement are you actually doing by tokenizing an asset, right? And it can be increased access, right? And I think that's a very real one. If you say, okay, you can make an asset available worldwide, but I think there needs to be demand for that asset as well, right? And what we've seen is that with a lot of the real-world assets, from a trading perspective, from an issuance perspective, they don't have the critical size in terms of issue size or value, right? That it actually was sensible from an economic standpoint to tokenize them, because when you get down to the nitty-gritty, it's not the technical part. That takes 2 weeks, and that's actually quite straightforward in my opinion. But the structuring, the legal structuring, what are you actually offering here? Is it a security? Is it a derivative? Is it none of the above? That costs a lot of money, takes time, right? So I think there needs to be real value creation. And what we've learned is that the end customer, whether that's an institutional customer or an end client, they don't care as much about the technology behind it, right? They care, is it cheaper? Is it easier to access? Can I buy fractional shares? So if you can offer that, great. But they don't actually really care what's the technology behind it.
But then when you're getting into fractional, you really are, ownership, title. It's a whole different ball game and minefield, right?
Yeah, real estate is a very good example here, because we don't have a digital registry, for instance, in Germany, so that makes it incredibly complicated. If you had that, right, then
I think quite a few people have tried to put a registration Bible on chain, for exactly that purpose, aren't they?
Yeah, exactly.
Simon, you wanted to cut in as well. I can see you itching.
I think it's a good example. Like, take a building, you tokenize a building, doesn't make the building more liquid. It remains the same market to buy and sell real estate, let's say. But I think you mentioned Jenny Johnson from Templeton. I think launching a fund is quite expensive, and having a token at the wrapper, it's only code, so it does make it cheaper. So think about the product that are currently only for pension plan or only for ultra high net worth. These can go down the scale towards like upper retail. So structured notes that are usually for high net worth could go like to the upper retail, because you could make smaller denomination because it's all code. Or QIS, like custom index strategies that are more like for the pension plans. You customize your trading strategy. You could go down in the scale. So I think tokenizing everything is wrong. Like, it's very often useless. But if there's value in like making accessibility better, there's often a good use case.
You want to jump in, do you, Laurent?
Yeah, definitely. Just to come back.
He's got the benefit of being next to me and going, I want to speak. Go on then.
I just wanted to add that Simon is right. The only downside of this is that we must absolutely make sure, and that's going to be like, I'm expecting increasing pressure from regulators to be clear about the substance of what we're tokenizing. What are you tokenizing? A token, a fund? Is it a native tokenization? Is there a counterparty risk and so forth? At this point in time, it is not always so clear. So I think that I'm expecting some additional pressure coming in order to have a very clear clear rules established in order to fix some problems that we see every day.
Well, I actually, I'm looking at you, Robby, because obviously your special announcement that you and Yat shared in my group the other day, thank you. Stable coins, I'm seeing this absolute explosion in stablecoin interest, and is that just another form of tokenization? And actually, is there a place for multitudinous different stablecoins, or should there be a bit more of a rigid approach to what effectively is tokenized money, right?
Sure. I think.
And what is a stablecoin? I know that's completely off topic, by the way, but I mean, it's kind of involved in this bit.
The stablecoin is the first product in Web3 that has found product market fit, right?
Yeah.
Because everybody understands the reason for tokenized money.
Doesn't mean to say we need 100,000 different stablecoins, though, does it?
No, we don't.
Yeah,
although we do have hundreds of different currencies, fiat currencies in the world.
Yeah.
So I definitely see the potential for having hundreds of different kinds of stablecoins, and they will be of differing quality and differing value depending on who wants to use them. And I think the market will ultimately decide which of those stablecoins are more used for what purposes, just in the same way that the market has decided fiat is useful for different things, and some people use US dollars
and
euros,
actually, presumably, Fireblocks, you would have something to say about whether you actually rate stablecoins or not. I mean, which particular, in other words, which ones that you would accept as not.
Well, we are seeing massive demand from banks in terms of leveraging stable coins. Banks, but not just banks, PSPs as well. The idea is just to take ownership of how you can actually move money and move value. And stable coins are one way of doing this. A few weeks back, we were invited by a core banking provider to present in front of a large American bank. And they were telling us we have 3 key use cases for 2026. One is crypto acceptance, so we can provide custody services to our high net worth individuals. 2 is tokenization of real world assets, so we can refinance some of our assets and provide access to third parties. And 3 was how do we not SWIFT? I.e., how do we actually use stable coins as
did you say SWIFT? Sorry.
SWIFT. Right. Okay. How do we not SWIFT? I.e., how do we actually use stable coins as an alternative to the traditional payment methods, so we can take ownership of our flows and we reduce the dependencies we have on other players. So we are seeing a massive growth in terms of stablecoins. To give you a sense in terms of the volumes that we secure, traditionally, since we cover both crypto natives and trade for organizations, we could see a real mix between Bitcoin, Ethereum, and main cryptos and stablecoins. Nowadays, it's close to 70% of the volumes that we're securing that are stablecoins. So we've seen a massive shift, and this is clearly the direction of travel for the next few months.
And how are you? As Robby said at the top of the introduction, you're actually making the. I mean, you got 800 portfolio companies thereabouts, is it not?
650.
Right? All right, I exaggerated. Just it sounded better. No, 650. Okay, 600. But still, it's a large number. Yeah. Why suddenly then this direction for you? And bear in mind that you decided to do this 3 years ago, and it's taken all this time.
So I think stablecoins are obviously one pillar of institutional adoption for digital assets. So I think that's very important. I think for us, it's a little bit of a project close to our heart because it is Hong Kong and that's our home. Yeah. And so we wanted to play as big a role as possible just in the transformation of Hong Kong into a center for digital assets. You partnered
with Standard Chartered on that, right?
Correct. Yes.
Another traditional.
They're the big brother. In this process. But I think it's also about how we can then leverage, in this case, a Hong Kong dollar stablecoin specifically to support Hong Kong industries and Chinese industries that transact using the Hong Kong dollar. And I think this is a lot of the role that we see for different denominations of stablecoins, because obviously not every country and not every company wants to denominate in US dollars necessarily. There's a place and a time for it, but it's not necessarily what they want to use all the time.
Well, we could always have a Trump dollar, I suppose. But anyway, moving on.
Maybe I'll disagree a little. I think you mentioned 100 of stablecoin players. So maybe I did not understand, but I don't expect to see 100 US dollar stablecoin being successful.
No.
Many currencies,
but maybe every fiat has their own stablecoin.
Yeah, but for a given currency, I think it's more like an oligopoly where you'll have a handful of players.
The market will decide.
Like you said, but I do see the potential to have many bank tokenized deposits. Yes. Because bank, and maybe Laurent, you can comment on that, but they do have a pretty strong interest in terms of funding, not to see the deposit fly away from them, and so they want to retain that by offering their own bank tokenized deposits. So I do see a handful of stablecoin per currency and a bunch of bank deposit on-chain.
Does that mean you're seeing, you see the direction of travel for stablecoins having, their own yield and all that stuff with it baked in? Their own yield-bearing stablecoins, for example?
Somehow, if you look at it, you're already able to do that. You don't call that yield, but you stake them and you get the yield. So this is already done, in my opinion.
Okay.
Chris, I think... Just to answer Simon, we're just... we're doing both. We're doing both, but for different use cases. That's what I wanted to add. Launching a stablecoin, I think it was announced yesterday that Crédit Agricole is launching its own. It's valid only if you have the relevant underlying use cases to make it live. Otherwise, it's just like going to happen with the seed you're going to have and the money is not going to move. The end of the game is just to make sure that it brings value to your use cases. As an asset servicer, we accept, of course, a lot of existing stablecoins from different issuers. We will issue ours as well. But because that we have a client demand, and that should be the answer to a problem. The problem is like a settlement issues. It could be some for the retail distribution. They want to use a stable coin which they trust into because we want to stay away from crypto for a certain period of time. And that's what we can offer. The biggest risk that we could have on the market is to see many issuers without underlying use cases. And that's also true for consortiums.
My turn to touch you up. Now listen, Chris, we've only got 3 minutes, 43 seconds, and I think it's only fair that you have the chance to talk about this subject now. Yes, you.
Oh, very nice. Yeah. So I think
touch me from all the way over there.
No, I think when we look at stablecoins, so first of all, we're quite agnostic in terms of what kind of stablecoin clients want to trade with us. It's very, let's say, client-driven. I think obviously as a market maker, there would be huge benefit for us to move over to stablecoins rather than fiat, simply because the settlement is much more efficient and fast. The problem that you mentioned that someone like Cumberland has over the weekend is the same thing we're facing, of course, right? So we have settlement cycles of T+1 with our clients, and I think we would want to keep that. So, when we talk about, for instance, instant settlement, that would make it very capital inefficient for us as a market maker because you basically have to hold assets at all times to settle them.
But also presumably a little dangerous.
Yeah, so we like to work with T+1. Nevertheless, the process on the settlement day takes 8 hours in total, right? And you could shrink that down to probably 15 minutes to half an hour because crypto is not the problem. The fiat leg at times is. But the problem, I guess, that we're seeing still is that, is at least for Euro, because we have most of our trading flow in Euro, there's not really been a stable coin that has established itself as, let's say, a clear winner or front runner in terms of the critical volume, right? You don't have order books that you can access, or at least not liquid order books for Euro stable coins. So I think that's a race that's still open. Laurent, maybe good luck to you to win it, or anybody else. We're looking forward to it because it would make our life, of course, a lot easier.
Right, so we got 2 minutes, 30 seconds each to wrap up. Simon, shoot.
Yeah, so if you sing Collateral, sing Canton.
Well, that was not 30 seconds. You're gonna build the clock up for Laurent again. Robbie, you have 35 seconds.
Sure. I was just going to say, I think also in this continued discussion of stablecoins and RWAs, the Venn diagram is how we think about how we define what is a stablecoin.
Yeah.
Because up until now, we've defined it as something that has treasuries or fiat on deposit backing it.
Yeah.
But I think we'll increasingly also start to accept other asset classes as being relatively stable. And so I think this is also going to change the complexion of how we think about it when consumers can access things that are ultimately backed by assets that are not necessarily fiat.
And provide confidence, obviously. Alex, you've got 45 seconds.
I'll be brief. On our side, we provide infrastructure, so we're agnostic to blockchains, stablecoins, tokenized deposits, or any type of assets. What I think is exciting this year is the fact that institutions are going on chain. It's my 6th Paris Blockchain Week, and I may have said before that this year is different, but it is really, really different this year.
True story. It is actually very different. Right. Okay, Laurent. 45, 46.
10 seconds. Last message.
9.
Don't try to burn the banks. Try to privilege the partnerships, and we have many things to do together.
Well, you could just bring a CACEIS ashtray next time.
You can try it.
Good. All right, guys. Well, listen, I think we're on time. We're out of time. And thank you all very much. A round of applause for our panel. Thank you.
Thank you.
Thank you.
Thanks.
Welcome to Signal Week.